Knowledge is power. Make an impact by learning more, or hire us to do it for you. Let us focus on what we do best so you can stay focused on what you do best. Find all of our options under services, one-to-one training, subscription-based training, or accounting and business consulting. Improve your cash flow by improving inventory turnover. Inventory is another one of these levers we can pull to improve cash flow. We've gone over, previously we went over the accounts receivable turnover. That was the first lever. Inventory is going to be the second. So, how do we do it? Easier said than done, right? Well, I love when people say that, well, it's easier said than done. Great. So we can either keep complaining about how it's easier said than done, or we can focus on how to do it and understand that we may have to do some work. Oh my God, we might actually have to work to grow our businesses. Imagine that. What a concept. So yeah, it's easier said than done, but we're going to focus on how to do it nonetheless, okay? But before we can even get into how to do it, there's a few things that I think are important to go over that lie at the foundation of anything we would do to improve cash flow by improving inventory turnover. The first thing, and I found myself answering this question again yesterday, actually, as of this recording, and somebody was asking, what's the best way to, to make sure the inventory is accurate, etc. And I said, count it. It comes, and I get this question a lot from clients, prospective clients, whoever, and the simple answer is, if you don't think your inventory is accurate, it probably isn't, number one. Number two, the only way to fix that, there's only one sure way to fix that. Count it. Count it, document that, count, and then we can adjust QuickBooks. And now we have a nice clean starting point. We've counted the inventory. We know for sure inventory is accurate. In theory, any deficiencies in the accuracy of inventory, the offset would be cost of goods sold. Because why would inventory be off? Somebody could walk out the door with something and it doesn't get recorded, which means inventory is overstated, cost of goods sold now understated, right? So when we make that adjustment, we subtract that item from inventory because when we count it, it's not there anymore, so it won't be included in the count. Right? And inventory then will get adjusted downward, and the offset to that downward adjustment in inventory will be cost of goods sold. So the natural offset to an inventory adjustment, of course, is the cost of goods sold account. And by the way, when we do this, we usually create a separate cost of goods sold account called inventory adjustments. Lets us track the volume of dollars that are going through that account so we can see if there's a problem. If we're consistently having to increase that account, we may have a problem and that inventory is consistently walking out the door and not being accounted for properly. So that's important. So that's the first thing we need to do is count our inventory, right? And then the next thing we want to do, and this is actually tied to the first way I'm going to go over for how to improve cash flow by improving inventory turnover. But before we even get into it specifically, I want to cover the obvious. Let's blow out old unsellable items, right? That's one of the reasons we count our inventory, by the way, besides getting the accurate number of the, for the value of inventory and the quantity on hand of everything, is in that process we can also identify stuff that's on the back of the shelves that's got an inch thick of dust on it because it's been on that shelf for way too long. And if it hasn't sold by now, there's a good chance it may not sell, but at least we can try. The logic is that stuff was probably bought a long time ago, so anything we can bring in for it now is better than zero, which is what we're likely going to bring in for it if we don't do something about it specifically. So it may be pulling out all those stuffs, and if possible, and if it's logistically possible, I always say, let's get that stuff off the shelves and put all that stuff on its own shelf so we have a real clear picture of what we're dealing with, and then let's put it on sale. Let's send some email blasts. Let's do some marketing. Let's give some coupons out. Let's just get the stuff off the shelves and get whatever we can for it. At this point, anything is better than zero, right? And that inventory is taking up useful space on the shelves that could be used for more stuff that is selling. So we definitely want to blow out unsellable items, okay? Now let's get into the two actual ways to improve your cash flow by improving inventory turnover. The first thing is something you do have a little more control over, is bleeding your inventory, which is similar to blowing out your old unsellable items, but you also may want to just bleed down inventory in general. We may be just holding on to more than we need to, right? Of course, we want to have enough so that we can fulfill orders, but I see a lot of cases where when I look at the inventory number that's on the balance sheet, the total value of the inventory, it's like way too high. And when I get to the end of the first sort of phase of this series that we're doing on Cash Flow Tuesdays, you're going to see how the the calculation that we're going to eventually do that tells you how much money you should have in the bank rests in a significant part on how much inventory you're carrying, right? The more inventory you're carrying, the more cash you need to have in the bank to cover everything, right? To make sure that you can buy more inventory. So there should be an established value that you keep on hand in inventory in total dollars, and that, of course, is derived from analyzing the items sold, how many you need to have on hand to cover the typical monthly orders that come in, right? And that's the analysis we have to do, but before we can do it, we've got to clean some stuff up, right? So bleed your inventory down. It's very likely, it's very frequently the case from what I've seen, that people are carrying more inventory than they need to be. And then it's simple math. If I'm selling more inventory than I'm buying in a given period, that means I'm bringing more cash in for the inventory that I have than what I'm putting out there to acquire more inventory. So simple math, if you want to increase cash flow, at least in the short term, because of course eventually you do have to buy more inventory, but if you want to do a short-term cash flow increase play, a strategy, then bleed down your inventory. Let some of it just blow off the shelves without replacing all of it. Replace less than you sell. Now the hard one and the obvious one, right? And this is the part where you're saying, easier said than done, Seth. Increase sales volume. Yes, of course, that's obvious, but I have some thoughts on how. And again, some of this is obvious, but the point is people aren't taking the time to sit down and actually do this. So sometimes I have to hit you over the head with the obvious so that you'll hear it one more time and say, okay, let's actually make a plan to do this, right? Instead of saying it's easier said than done, let's actually sit down and see what can we do to increase sales volume. Of course, we're going to be talking about advertising and marketing, online advertising, social media, email campaigns. Also, take a good look at your SEO. How are your product descriptions doing? Do a search as if you were a customer looking for something that you sell and see what comes up on top. Do your products come up on top, right? If not, look at the ones that do. They've probably done a better job in writing their descriptions. They've done a better job with their SEO. There's a good chance of that. So, play this stuff. It's not a set it and forget it process. It's an art. You have to keep playing with it. Advertising, marketing is an art. You have to keep changing things until you get it right. And you know how you'll know when you get it right? When all of a sudden you hit that tipping point and all of a sudden the sales start kicking over. Because you know your products and you know your market. You know when there's something that should be selling that you're carrying that isn't, right? Which means it's not a product you want to get rid of. It's a product you need to figure out how to do a better job of getting it to show up on top of those search results, or a better job of getting the word out there that you have this product to offer people. So again, email blasts, online advertising, social media campaigns, and last but not least, before I show you some actual accounting stuff, is looking at finding mentors, people who are already doing this, who are already where you want to be, people who don't necessarily compete with you. Maybe they sell different products, but clearly they know how to get things sold on sites like Amazon or eBay or their own website, and find those mentors and get help from them. I know from my clients who are Amazon sellers that there are Amazon seller forums that they participate in, so if you're not already involved in that kind of thing, go get involved in that kind of thing. Now let's take a look at some of these reports, because here's what I really want to show you in terms of getting into this. Because, like I said, you want to count it, but then you want to analyze your inventory. You want to look at what things am I selling? Is there the stuff that's sitting on the shelves that's collecting dust, the stuff that we had to blow out? We don't want to carry more of that, obviously, but we want to look at our reports in QuickBooks Online, for example, and see what products can we sell. Now, I'm using a sample company file. This is the QuickBooks Online test drive file that they have out there. So it's a little bit limited in terms of what I'm showing you, but it doesn't matter. The only difference is yours might have a lot more items on the list, but items are items nonetheless, right? So this is a sample design and landscaping services company where they do have some inventory items that they sell, right? They sell rocks and they sell fountains, concrete pumps, rock fountain, so they sell some products. And a product is a product. On the accounting cycle side, when you're analyzing it, it all pretty much works the same. We sell a certain item in a certain quantity, we pay something for it, and we charge something for it. In the most generic terms, it doesn't really matter what products you sell. What I'm trying to show you here is how you can run some reports like this one, the sales by product or service summary report, so that you can get some insights into what is selling, right? And you want to look at this kind of month over month, right? This report shows you the activity over a certain date range because it's a sample company. I've just set it for all dates. But you might want to look at this for last month and then look at it for this month. You might want to dump these into Excel so you can compare them side by side so you can see what products month in and month out are selling consistently, right? The other thing to look at is this one, which is the inventory valuation summary report. This just shows you after you, for example, you've done your inventory count, this shows you what you've got on hand. It'll show you every item that you have on hand, how many you have, and what the asset value is. By the way, going back to this report, it also gives you some nice information about what the average cost of sold is for that item. Based on that, the gross margin and the gross margin percentage. So here's where you can also look and see if the quantity sold for the period that you ran this report for is consistent with your understanding of what it should be, right? And bottom line, we want to look for those items with perhaps a higher gross margin, because the same effort put into getting more of those sold will pay off that much better in dollars, right? So we want to look for those items, those sort of sleepers that have maybe a high gross margin but aren't selling but could be selling more. So these are the kinds of considerations we want to take a look at. The other report I'll show you is this one, which is the sales by product or service detail. So it's the drill down on this report. This was the sales by product or service summary. Over here we have sales by product or service detail. So what this does is it shows you every single transaction within each of these accounts, right? So we can go right down to the products like the pumps and see how many pumps are we selling. And, you know, we've got the customers. We can see exactly who we sold it to and what. And again, this is good to look at on a comparative basis. So I want to look at this month over month to see what we're selling when. Maybe we have products that are cyclical in nature, so I want to make sure I understand when those products sell more, because maybe a month or two before that is when I want to start gearing up those online advertising campaigns and really leverage that, you know, ride that wave, so to speak, that I know is coming. So those are the times I want to anticipate putting more money into advertising, because the whole idea is ROI, or return on investment. I want to make sure that I get the greatest return for the amount that I spend. Right? So when's the best time to do that? Well, the best time to do that is to ramp up your advertising just before you know it's the time that this product typically sells more already. That's what we want to jack up sales during those times. And like I said, kind of ride that wave. So it's important to look at these kind of reports to understand how our products sell, where our products sell. Hopefully you're not just selling on Amazon. I'm sure a lot of people do. It's a mistake. I'll be writing another article about why I feel that way. So just keep checking back. I promise you it's coming soon. But, well, let's put it this way. So if you are selling on other sites besides Amazon, you want to be able to compare how are these products selling on Amazon versus the others. I did a video not too long ago giving you an example where I changed information around, but it was a real client's data, and you could see the difference in the profit margin between Amazon and the other sales channels. So, you know, and that right there gave you a very telling look at why you should consider other channels besides Amazon. I'm not saying don't sell on Amazon. You need to, but you should also sell on other platforms. Last but definitely not least, cashflowtool.com. This is a powerful tool that will help you analyze cash flow in all different ways. And so you don't have to be an accountant maybe to read all this stuff. And I don't think you do need to be an accountant to know how to read all this stuff. I think people think that. But if you take a minute and be patient, mostly with yourself, if you're not an accountant, but you look at this stuff, you'll start to see it's pretty common sense stuff. It's not rocket science here. But come over here to cashflowtool.com, and I've created a custom dashboard just for inventory and things that I want to analyze when I'm thinking about my inventory. So one of the things I put in here is the largest sales, the top 5 customers, right? So, and again, this is a sample company file, so bear with that aspect of it. But the idea is I want to see who are my top customers. I want to find out what they're buying, and maybe I can look at, for example, what Tropicana Outlets is buying, and if they're buying stuff that's different from Jimmy's showroom, I might want to go to Jimmy's showroom and say something like, hey, other customers like you are buying these other products. Maybe you would like to consider those products. You know, you get the idea. So definitely something I want to look at in terms of, again, how to boost, how to increase sales, right? Because the more I turn an item of inventory over, the more frequently I turn it over, the more profit I generate, plain and simple. Days cash on hand, not necessarily specifically tied to inventory, but it's a really good thing to look at no matter what. This number, and by the way, the cash flow tool, if you're not familiar with it, will pull the data right out of your QuickBooks Online or QuickBooks Desktop company to put this information together for you. It's all done for you. And it tells you this is based on the cash available and the average daily expenses. So if you have no new sales, your cash will run out after 123 days based on your typical expenses. Gross profit margin, definitely something we want to have a close look at when we're selling inventory. That's kind of the whole key here, right? Of course we need to look at overhead too, but this is the first part, right? What do we sell everything for? What did it cost us? And what's that difference is the gross profit margin, right? 79.2%. Is that high? Is that low? I don't know. It depends on the industry you're in, the kinds of products you're selling. But I would say, and I frequently say this whenever I talk about gross profits and gross profit margins, is I'm not, as an accountant who serves companies, I'm not as much concerned about where you are compared to your industry. I get the value of that, but I'm much more concerned about where you are now versus where you want to be and how we can get there, right? 79.2% gross profit looks pretty good for probably any industry. Not sure if we would be able to go much higher than that. If you have 100% gross profit, I'd be scared because I would think something's very wrong. How can you possibly sell something without having any costs going against that, right? Your cash ratio, also a good thing to look at. It's the ratio of your cash to your current liabilities. In this case, what this is saying is we don't really have enough money to pay off our liabilities in the short term. So that's not good. We can only pay off about half of it with the cash we have. And remember, I made a mention earlier that we're going to get into a calculation that will tell you exactly how much cash you should have on the books at any given time. So this is a little bit of a look into that, right? We don't have enough cash on the books. It should be at least one. Average cash gap days, right? This is the number of days for money to come in after you pay a bill. So you send $1 out to pay a bill. How long does it take that dollar to come back in the form of a sale, right? 98 days. Again, good or bad, really depends on you today versus where you want to be with this. If you see that it's 98 days, maybe you want to get this down to 80 days, and then you can, once you make that decision, you can talk about ways to do that, and you can have the conversation right here in cashflowtool.com between accountant and business owner, or accountant, business owner, and staff, whatever that is. This is the place you can do it, and do it very easily and keep things in context, right? Average days of inventory, very, very important, right? How long does it take to get something sold? How long do your products sit on the shelf as of the previous month then before they get sold, right? How long on average does it take you from the time you receive an item to get it off the shelf and on its way to a customer? Again, good or bad? Depends, and again, my point is, good or bad doesn't really matter. What matters is, can we get this any lower? Can we improve this? This is a number that you want to reduce. You want things to sit on the shelf for as short a term as possible. You want to sell it, replace it, and sell it again as many times over as you can. That's the name of the game with inventory. Cash shortage, it says you don't have a cash shortage because your working capital is greater than the cash required to close the cash gap. Again, stuff we'll get into deeper as time goes on, but rest assured, this is a good thing. It's telling us that it's a little bit in conflict with what this says, but a deeper analysis would reveal, what the difference really is. But bottom line, my friends, there are tools like this that you can reach out and get your hands on that will make your life easier, that will make it more efficient to analyze this kind of stuff and make the decisions that you need to make. At the end of the day, when we're talking about inventory, we're talking about keeping stuff on the shelves, like I said, for the shortest possible term and turning them over as many times as possible. If I have an item that's got a nice profit margin and I sell it 5 times in a month versus 1, well, obviously selling it 5 times inside of a month is better. That's your inventory turnover. This is what we want to work to improve. I've given you some things hopefully to think about to help you accomplish that, so that you can stop saying, oh, easier said than done, and start saying, hey, you know what, this stuff makes sense. What can we do here? What else can we do? I'd love to hear your ideas, so post your comments and questions below wherever you happen to be watching this. If you are on YouTube or Vimeo, check your descriptions for a link over to the blog post with a detailed write-up, more like it. And of course, that's the best place to post your comments and questions, and I will get back to you and answer them or respond to them as needed. As always, I hope you had some fun here. I hope you learned something along the way. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.